Welcome to the Financial Modeling Podcast, Short Stuff, where we discuss elements of the Financial Modeling Podcast in 5 minutes or less. Stay tuned for today's financial modeling tidbit with your host, Matthew Bernath.
Welcome to the Financial Modeling Podcast, Short Stuff, where we concentrate on one element of the financial model and delve into it in detail. Today we're going to be discussing the Debt Service Coverage Ratio, or the DSCR. What is the Debt Service Coverage Ratio and why is it so important? Well, to banks this ratio is exceptionally important. In fact, it's so important that they make it a covenant on their deals, that if you breach this covenant, this DSCR covenant, you are in fact in default. Why is it so important? Well, the debt service coverage ratio determines how much cash you have to service your debt, both your interest and principal payments on your debt. Now, in a project finance model where there are multiple tranches of debt, you might find both a senior and a total DSCR, or debt service cover ratio, where the senior DSCR only focuses on the cash flow available to cover just your senior debt payments, while your total DSCR says how much cash do you have available to pay for your debt, and that's all of your debt, both your senior debt and any mezzanine debt and any other tranches of debt that you may have. As you can imagine, based on this, if you have multiple tranches of debt, your senior DSCR will be higher than your total DSCR. So, what does it mean when you've got a DSCR of greater than 1? Well, it means that your cash flow available to pay debt service, or CFADs, is greater than the debt service itself. Now, obviously, for a bank, if you have a DSCR of 1 times, that's cutting things quite fine. In fact, one minor technical difficulty in your wind farm or one minor upset in your business means that you suddenly can't fully cover your debt. For this reason, the investment bank will typically look for senior and total DSCRs quite a bit above 1, and typically for senior DSCR you might be looking at 1.3, 1.4 times depending on the deal. So what does the DSCR look like over the life of the debt? Well, in some projects you might find that the DSCR is upward sloping because your debt payments might stay the same if it's maybe an annuity or mortgage style bond, or loan repayments where it's your same total value that's being paid in each period, so your interest and your principal always sums to the same total. Whereas your cash flows might be increasing over time, your business is maybe doing better, or your revenue line is increasing in line with CPI, and your DSCR might be upward sloping. What we also might find is that you've got a sculpted debt repayment profile, and we'll talk about sculpting in a different Short Stuff episode, but when you have a sculpted debt repayment profile, it means that your DSCR is usually pretty constant, and you might find that your DSCR looks like a straight line throughout the debt life cycle. Senior debt can in fact be sized based on the DSCR, so if we perhaps have a DSCR of 2 times with an average DSCR of 3 times, we might say, hang on a second, this project or this company can actually afford more debt. Let's gear up the company or project more, and we can in fact put more debt into the project. So DSCR can also be used to size your debt. But in general, it's used to see how strong the cash flows are to pay your debt service, and it is typically calculated on either quarterly, a semi-annual, or an annual basis. Your DSCR can be both backwards and forwards looking, and as I said, it is typically a covenant in your term sheet, so that if your DSCR drops below the covenant, they can lock up distributions to shareholders and in fact even place your company in default. So DSCR, exceptionally important that it's calculated correctly, and basically what it does show is that if you've got a DSCR of 1.3 times, it means that you're 1.3 times covered. That you're well covered for your senior debt. Your cash flow available for debt service is 1.3 times your total senior debt service, and that you have some buffer there if things go awry, you can still pay for your debt. This has been Financial Modeling Podcast Short Stuff. Please subscribe to our newsletter as well if you want to learn more about financial modeling at financialmodelingpodcast.com. Please also rate us on iTunes if you enjoy the Financial Modeling Podcast, and I'll see you in the next episode.